well, we have with us Rahul Arora, CEO of Nirmal Bang Institutional Equities, joining in. Good morning, Rahul. Happy New Year. Thanks for joining us. How are you feeling about 2025? It's looking like a tough year for Indian equities. Not like the previous year was easy, but nevertheless.
Good morning, Samina. Happy New Year to you and the entire team and the families. Yeah, I think it's going to be an interesting start to the new year. We have a new president getting sworn in to the United States in a few days from now. We have the union budget in about 3 weeks from now, and then we kickstart earnings later this week. So I think there are a lot of moving parts. Add to that, while the geopolitics seems to be somewhat okay, there's no significant deterioration on that front, but I think news flow on the health front from China hasn't been too or rather, let me put it this way, has been a little disconcerting for the markets over the last couple of days. So I think it's going to be an interesting 30 days. It's going to be very difficult to take a directional call. I think it'll probably be best to take a directional call, say, closer to the mid of Feb as to how the rest of the year pans out. But this is going to be one hell of a challenging year, I think, whichever way we look at it. And all the things that I said notwithstanding, just principally because I hope last quarter's results were not anything to go by, because they were probably the worst quarterly results in many, many years that we have seen. If we are able to follow that up with a good earnings season this time around, or at least better than what we had last time, we could probably safely say the market had found some flow. But if earnings continue to be bad in the wake of an uncertain US environment, an uncertain China environment, then I don't know. Probably all bets are off as to what the market does then.
Good morning and a Happy New Year, of course, formally on TV. But here's the question. The updates that have come out thus far don't inspire the confidence, right? I mean, GCPL mid-quarter 3 gave an update about a weak quarter 3, and FMCG will likely dole. Banking numbers haven't necessarily been the best. Yes, there is an odd Bajaj Finance, but otherwise fairly quiet. Very likely we'll see not so great an earnings season.
I think you've hit the nail on the head, Neeraj. I think if you look at the composition of the Nifty today, you are almost, 40% BFSI, IT services is about 12-13%. Consumer will be somewhat similar. And if you add a Reliance to it, you're already talking about 75% of the Nifty. So I think when you talk about an earnings upgrade or a downgrade cycle, I think these 4 pillars of the market have to play very important roles. As you rightly pointed out, and in fact, we had put out a very detailed thematic recently which said that credit and deposit growth has converged after a very, very long time. And it's not inspiring too much confidence, because I think, credit growth has dropped down to about, depending on which month you pick up, because we put out a sectoral credit deployment report, it's hovering between that 11 to 12.5%. And if the economy continues to slow, then there is a risk of that slipping into single digits. I think you're bang on, Neeraj, in terms of the commentary that you're talking about from consumer companies. I think, even Hindustan Lever is struggling to give you 2-3% kind of volume growth. The only consumer companies that you're seeing, positive traction are consumer discretionary companies. I think you saw that in the commentary of Jubilant. We've done some challenge checks in the alcohol beverage sector. So I think there's some positive commentary coming there from hotels and aviation. But if you strip that out, I think core banking, core consumer is a bit of a challenge. We put out our ID sector preview, earlier this morning. Barring HCL Tech in the large caps and something like a Coforge and a Persistent in the mid caps, I think most other companies are probably going to grow at between 0.5% to 2% quarter on quarter. I mean, these are not numbers, Neeraj, that you'll want to pay 25, 30, 35 times. And for consumer companies, 40, 45 times valuation. So there is certainly a challenge as far as earnings is concerned. I think, Neeraj, I think the optical number is now less relevant. I think the market will cheer if, say, a 2-3% volume growth for lever goes to a 5%. I think the market will cheer if a 10-11% credit growth was to go to a 13%. Optically, these numbers are bad, but they're still better than, the previous bad number, so to speak, the lesser of the two evils. But you're absolutely right. I think, Neeraj, when you're looking ahead to FY26, I think, the best of margin expansion seems to be behind us. The best of deleveraging seems to be behind us. So even getting a 15% earnings growth could be a bit of a challenge for the fiscal year that we're getting into. I think the only positive that the market could potentially hang on to is a positive budget. Like I said, the lesser of the two evils in terms of the result season, and perhaps maybe a rate cut before the fiscal year ends by the Reserve Bank of India. If these three things happen, at least we'll be able to say the market has found some sort of a floor in and around where we are currently. But all things said, I completely agree with your point that given the commentary that we have seen, it's not looking all that bright as of today.
Rahul, hi, Tamanna here. So just looking at what the light is at the end of the tunnel or the silver lining, you're essentially saying it comes down to what North Block does and what the RBI does. Not so much demand consumption of the private sector at all. Then where is the bet?
So Tamanna, if I was to just break it down in a very simplistic way, right? If you look at growth, when you're talking about growth, and you look at the formula for GDP, which is C plus I plus G plus X minus M. Now the X and M is export and import, as we know, but that can change so dramatically if Trump does something to tariffs, not only to China, but to India and other emerging markets. So at this point, to take a definitive call on X and M could be a bit of a suicidal call. And, we've seen the balance of payments and we've seen the current account deficit numbers that are coming in. A lot of that is being driven by gold imports that we are having. So, what is the stance that the government and the RBI takes in terms of gold imports? The point I was making to Neeraj earlier about credit growth, a lot of that against also is for loan against gold. It's not so much against property and vehicles and so on and so forth. So I don't know so much about the X and M part. But you're down to C, I, and G. C we just discussed. Has a bit of a problem. Consumption, there is, barring discretionary, there is a problem. So you're down to investments and government spending. And I think, generally in India, private capex has lagged government capex. And I think that's why, most people, I'm sure that you also have spoken to over the last 3 months, would have told you that the onus squarely lies on government spending from here. It's because the other four legs are not aspiring too much confidence that the onus has come back on state and central government to lead the capex. Now, whether they do it through infrastructure, irrigation, ports, defense, railways, etc., remains to be seen. But I think that will probably have to kickstart, and which is why we think at our brokerage house that even though valuations, fluctuate very wildly in these PSU government-related stocks, it may not actually be a bad theme to be playing, including something like a defense, because the order books are there. Even if these guys just execute the order backlog that they have, these guys can grow at 20-25%. That is the strength of the order backlog. So I think consumer discretionary, government capex related stocks could probably be two places that we could certainly look to hide. And within consumer discretionary, like I said, hotels, Alcobev, aviation would probably be our preferred areas.
According to Bloomberg, 433 stocks from the NSE 500 for which earnings estimates for FY26 are available. A staggering 273 are trading at P multiples which are north of 25 times FY26 earnings, and another 85 are hovering in the 15 to 25 times range for FY26. Now this is stretched, is what I would think, right? No matter how well the next quarter is, valuation still not showing signs of easing, in my opinion. Would you agree? And would you then wait for valuations to become a little more acceptable before you make any sort of considerable allocations?
So there's two parts to that, Samina. One is that the reason you saw the stock price reactions at the end of the previous quarter's results is because most sectors and most stocks in India were trading between 1.5, 2 to 2 standard deviation above 3 and 5 year means. So that was the one, consensus call that everyone had, that valuations across the board were expensive. And that's why you saw the exaggerated sell-off. The second point to that, Samina, is despite, let's say the worst of negative flows or news points that you have around a particular sector or stock, the liquidity in the market is so much. And this is not a today phenomenon. I'm sure you're tired of hearing about it as well. This has been the case over the last 4 or 5 years, since the low of 7,500 on the Nifty during the lockdown, that every quarter when you have funds or foreigners making their adjustments, you are finding that the pressure on quarterly performance has increased from a fund management standpoint as well. Obviously, there have been certain, regulatory changes as far as mutual fund managers are concerned, where some part of their salaries are locked into their funds as well, which has increased the pressure on performance and has probably made the horizon a little shorter in terms of monitoring it. So, the famous QSQT that we used to talk about with respect to earnings, that has actually come into the fund management industry to some extent as well because of the pressure of performance. Now, what happens is, I think those days where you saw, major derating of stocks, on shallower liquidity, I think are a thing of the past. Today, if you have a good quality stock that's down 15-20%, I don't think the market is waiting for much more in terms of correction, because they're like, agar main nahi le lunga, koi aur le lega, and they don't want to miss that 5-6% of alpha on a particular stock. So while you are seeing corrections, and you're probably seeing more time corrections than absolute price corrections, a classic example, like Neeraj was talking a little while back, we downgraded the defense sector. I remember within 3 months of us downgrading the sector, while the stocks were down 50%, they rebounded 50% in the next 1 month. So I think that's probably what's playing out in the market, is this fear of losing out if you wait too far on the sidelines. And that's why cash deployment is happening. Samina, the one very important thing is, for a lot of first generation people who entered the market post 2020, 2021, they've not seen a meaningful correction in the market. And to be fair, I know stocks have corrected in a material way, but you can't really call a 26,500 Nifty down to a 23,500 Nifty a correction when you had a Nifty go from 7,500 to 27,000. So you've had a Nifty that's gone up 4x and you're down 10-15%. I understand we as human beings have a recency bias and we don't look at how much money we've gained in a rally, but we tend to look at how much we've lost from the top. But I personally think that despite the challenges that we have, the liquidity in the market will provide a support, which will be an optical illusion. But I guess that's what we have to live with.